Hello, Oracles. Today we're going to be going over stock gap analysis for Amazon stock and the Dow Jones Industrial Average. So this is a series that I started up about a month ago, and I'm going over once a week different stock gaps that we can see when it comes to stocks, ETFs, and indices. So if there's any stocks or ETFs that you guys want me to go over and take a look at the stock gaps on, let me know and I'll put them here on this channel on the weekly basis. Now, for those of you guys who don't know, a stock gap is created when a stock opens higher or lower than it closed the day before. For instance, if a stock closed at $100 one day and the next day it opens at $105, you now have a gap between 100 and 105. A lot of times we do see intraday, the next day that ends up getting filled. So maybe first 30 minutes of the day, you see that dip back down to 100 and then it goes back up again. That happens more often than not. But there are some times that it does not come back down that next day, and it could take a week, a month, or even a couple of years to come back and fill those gaps. We saw that happen with Tesla when it came to 2022, where it filled gaps that were up to 2 years old. So now this is technical analysis. So for long-term investors, it really doesn't hold a lot of weight when it comes to a long-term investor thesis, unless that long-term investor is looking for an opportunity to buy in lower, and they want to use the charts to kind of give a map of to where we could potentially see the stock price coming down to if they wanted to place a buy when it came to a little bit of timing. But for anybody who's not trying to time for a long-term investor and you're dollar cost averaging, a lot of this doesn't really mean a lot to you other than just maybe educating yourself on stock chart analysis. But when you're looking at swing trading or options or things like that, and you really want to find out timing of what we could potentially see in the stock, then looking at the charts is very important. And stock gaps are one of those things. Now, stock gaps fill 9 out of 10 times. Again, it's not guaranteed, but 9 out of 10 times historically, stock gaps are going to fill. So we'll go over the stock gaps today and I'll show you guys what they look like on the chart. When you're looking at swing trading, you're saying, hey, I'm kind of looking at what level we could potentially come down to buy more at. You can look at some of these stock gaps as a potential area to go to. When we looked at those when Tesla was coming down, as it was coming down, basically every time it hit a gap, it stopped at that gap. It would fill the gap and stop there. And then you kind of waited to see, all right, we're going to go back up from here, or are we going to continue going down? Now, stock gaps are also created on the way back up. So when Tesla was falling down, there were gaps that were created as it collapsed. So there were gaps above us that we just recently ended up filling as well. So if you think long term, the company that you're investing in is going to be very strong, and there's a gap above you, there's a good chance that we are going to end up getting back at some point to fill that gap above us. Now, when you're looking at a company that's maybe collapsing and they're going under, you see those gaps above you, there's a good chance they probably won't come back up to fill those. But that's individual stocks one by one to pay attention to. And again, if you guys have any stocks you want me to go over, I can definitely take a look at those for you and we can do an analysis on it to determine, hey, do we think that company's actually going to come back up and fill the gaps above it? Or we can discuss what's going down for the gaps below it and when we think we're going to bottom and bounce back up from there. And now the other thing you could take away from these stock gaps as well, especially if you're a long-term investor, is if your conviction in a stock or company isn't super strong and you're starting to see the stock and the stock price come down significantly and you're like wondering why, you could take a look at the stock charts and some stock analysis, and you can look at gaps like this and say, all right, well, it's falling down. And you could say, well, the sentiment is bad. Is this a specific company thing? Is it going to be a macro environment thing? What are the charts looking like? And you really should take your emotions out of investing. It's really not wise. You don't usually make good decisions when it comes to investing when you're using your emotions. I had to teach myself that as well. I was definitely guilty of it. But when you're starting to do that and you're learning how, all right, well, this is why the stock is moving the way it is. This is how the market works. This is how it gets manipulated one way or another. And then you can start understanding the fundamentals of a company and valuing a company. Then that's where the important stuff comes in is stock chart analysis and sentiment kind of go hand in hand. And when you're looking at the fundamentals of a company, that's based off of their valuation. If you're a long-term investor, you really need to understand valuation of a company because the stock price movements can be manipulated so many different ways. So you really need to make sure that you understand the valuation of a company. So if you see it pulling down in the stock price, you're not emotionally getting pulled out there and saying, oh, everybody else is selling, I need to sell also. You can say, hey, the company I'm investing in is amazing. The fundamentals are strong. I'm actually going to be able to buy this at a discount. Now I want to buy this when everybody else is selling. So it's very important to understand that as well when it comes to technical analysis and these stock gaps. All right, so we will jump right into Amazon here. And Amazon looks very much like a lot of the Magnificent Seven and other tech stocks that we have seen on here as I've done these stock gap analyses. And you're looking at a gap here down to the beginning of December that goes down to $214. And as I said, these are the gaps that you're showing here. So It closed here at 213 and it opened the next day at 215. Came back down a little bit intraday, but it did not fully fill that gap. So that's why we have that gap from 214.02 to 215.75. We also have a gap a couple of days earlier going down to 208. And then at the end of December, we have this gap that goes down to 190. Now, prior to this, you can see this gap here. There was this giant gap down here in Amazon. This was right before we had that big August sell off. And this giant gap here, this would have been one to pay attention to see if it was going to get filled on the way back up. And sure enough, it did. So over the next month, we definitely came back up and filled that gap. And then you can see here, there was another gap back here in February that was created, giant gap on February 1st. But as you can see, we went up, and even from there, look at this. The price was at 160. We ran up to 201 and then still came back down and filled that gap. So a lot of these people who don't understand how the stock market is manipulated and can see this and say, "Hey, the fundamentals tell me that, we should be here. This is where the price could be on it." But when it comes to actual manipulation, there's a lot of people out there who work with hedge funds or whatever it is, and they say, "Hey, I see this as a very strong potential in a company, but I missed out on this giant run here. I want to get back in at these prices." So it gets manipulated back down to these prices here. And then their friends can go in and buy in, and then it goes up from there. And anyone who wants to deny that that actually happens is just lying to themselves, because that is literally what happens. Jim Cramer has talked about it himself, and that's how hedge funds work. So, again, these are just things to pay attention to when it comes to these stock gaps, and understand that these areas here, when it comes to stock chart analysis, it's sort of something that just needs to get finished off. It's incomplete. And when the algorithms and stuff look at it, it's just incomplete. And even before computers and algorithms came in, this still existed. And it was just an incomplete thing. It's like when somebody comes out and goes, dun, 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 and you're like, oh man, well, where's the rest? That's exactly what this is. So everybody wants that last note to come out to fulfill that sequence. That's exactly what you're seeing when it comes to stock gaps. So it's just waiting for that final note, and that's what ends up filling these. And like I said, here in February it was created and it got filled in August. And now you go further back here, and then going all the way back to October of 2023, so a little over a year ago, we have a gap down to 121. And then going back to May of 2023, which anybody who's been following this series knows, May of 2023 was an area where we saw big gaps created in a lot of different areas, and Amazon is one of them as well. So there's a gap down to 106.79 back to May 9th of 2023. And so again, when it comes to these stock gaps, they don't have to fill. Historically, they fill 9 out of 10 times. As far as I'm concerned, and I've talked about it with Tesla and these other companies as well, as there's kind of like two different levels of gaps that I'm looking at to get filled. There's one where, hey, if we get a mild recession, just kind of a healthy pullback and a correction, there's a level that we're going to be seeing pulling back when it comes to these gaps. I think that 190 level is going to be the healthy area when it comes to Amazon. And if things get really bad, I think we might pull down to that 121 level. So it really is going to depend on the macro environment and what is going on there to determine whether we're going to be pulling down to those specific levels even further down. And Amazon, I think, is going to be in that scenario as well. So we'll probably fill that 190. Who knows what's going to happen from there? Maybe pull down a little bit more depending on what's happening. And then if it gets really bad, then we pull down and we fill that 121. But those are the two areas that I'm looking at when it comes to Amazon. Amazon's one of my favorite holdings that I have. I think they're going to end up paying dividends in the future as well. So I'm really just adding to Amazon right now, very similar to what I'm doing with Tesla, not selling anymore, just continuing to add to my position. And I'm going to continue to build it from here. And if we get a bigger pullback, then I can add even more at those levels, and I'll be able to build up and buy more shares for less. All right, now we'll look at the Dow Jones Industrial Average. And again, the indices are also susceptible to gap fills. And so while you don't usually see as many gaps when it comes to the indices, they do get created. So sure enough, right after the election here, we have a gap that goes down to 42,258. So I definitely think that this one's going to get filled. But as you can see, a lot of the trends that we've seen over the last month, we have seen this massive bull pennant get created here. That is where you see this kind of like bull flag here. It almost looks like a flagpole. And then here's their flag, and then it jumps up from here. So you usually see this flag created, and then it breaks out and goes up. So we're kind of at that point again as well. So we kind of topped at that $45,000 level. Now we've been on a downtrend here, creating another flag. So the question is going to be, is it the data this week that we're going to be getting that's going to create this bump up here, or are we going to fall down from here? Now, again, I do think at least by the first of the year, or when Trump takes office, we're going to see the big pullback created in the first quarter of next year. And that there, I think, is going to pull us down to fill this $42,000 gap. So I'm just kind of paying attention to what's going on. So we have to see what's going to happen for here. Do we get a Santa Claus rally and maybe push up over 45,000, maybe push back up to 45,000 again, and then come down and fill the gap? We just have to wait and see on this. Now, there is another gap that goes down here to early September of about 41,100. And then prior to that, there really aren't all that many gaps until you get back to November of last year, where there's a whole bunch of little gaps that were all created down to this $33,000 level. Now, don't forget, we were on a massive downtrend last year from this whole entire August to November timeframe where the market was just dead cat bouncing all the way down. Then it was at the very end of the month we started to take off again. So we've been basically been on a massive bull run for a little over a year at this point, and there were some gaps that were created. So I think very similar to as I said with Amazon, I think the healthy pullback is going to come down and fill that $42,000 gap. But if we end up getting into a recession and pull back significantly further, we can start seeing some of these get filled and come back all the way down to this $33,000 level. Now, you may think that that's insane pulling all the way down that far, but it realistically isn't all that much. I mean, that's about a 25% drawdown, which, for a bear market or a recession is actually pretty normal. So if we end up getting into that recession, pulling down to this $33,000 level is an actual normal thing that we could potentially see during a recession. So anybody who thinks it's crazy needs to understand that's how the market works. Seeing a 40% drawdown on the S&P 500 is not unheard of. It has happened before, and chances are it's going to happen again. So the Dow Jones Industrial Average would end up doing the same thing, and pulling down 26% is not out of the ordinary. And so those are the things that I'm really kind of paying attention to. And again, the stock market is a transition of wealth from the impatient to the patient. Now, of course, people who are waiting for this bear market to happen every single year are missing out on a lot of these massive gains that we're on. But then that really comes down to timing of the market. And if you want to play that swing and you want to time it, that's fine. And again, a lot of this stock chart analysis is based upon a lot of people who are swing trading and playing that timing. But if you don't want to time it, you just want to invest and hold it for the long term, then just understand that we are at a relatively expensive point in the market right now. It is kind of frothy as it is, and the forward PE ratio on the entire market is on the higher end of its historical norm. So we're just kind of waiting for it to pull back down a little bit, which again, these are the natural swings in the market. So when you're looking at fluctuations in the market on a daily and monthly basis, it fluctuates a lot. When you spread that out over the course of 5, 10 years, those daily fluctuations are barely even there. And you see a little even more flow when it comes to the stock market itself. And it's easier to follow those flows and waves. It's kind of like long-term investing is like a lazy river, whereas day trading is kind of like being on whitewater rapids and falling off of a waterfall. So it's the two different styles of investing. And some people really love the rapids and they want to go out there and do that. Cool. That more power to you. I'm more of a lazy river investor. I want to go out there and just kind of float along and enjoy the thing and relax and just kind of enjoy the scenery and what's going on and take it from there. That's my thoughts. And when I see something like a waterfall and I see this big crash coming, I was like, hey, I can enjoy that from a distance because I'm not getting myself involved in that. And I can enjoy the beauty of it without actually having to feel the emotions of falling off the edge. So that's how I invest. And I know obviously there's everybody who's different, but you guys can let me know your thoughts in the comments below how you feel in that regard. If you are a whitewater rapid investor or if you're a lazy river investor. Again, I'm the lazy river. I'll take it that way. So from a lazy river, I can see, hey, there are some big rapids coming up ahead potentially, or there's a waterfall coming up. I'm going to be able to prepare myself to enjoy that. And I'm going to get myself off in the distance. And if I want to, maybe I'll get myself around there and I'll take some pictures. And that's where I'm going to be buying some as it comes down. And so be it. And again, if I think that there's a waterfall, but it really doesn't turn out to be a waterfall and there's no rapids, it doesn't matter. I'm still invested. I'm still going to enjoy the ride and still keep going forward from there because I'm still invested in that journey. So that's my wisdom for you guys. Let me know your thoughts in the comments below. What do you think is going to happen over the next year? Do you think we're going to come down and fill these gaps? Do you think that the Dow is actually going to fall a little over 25% to fill those gaps at 33,000? Or do you think we're going to avoid that and just continue pushing up from here? Thank you guys so much for watching. I appreciate all of your support. Have a great one.